Hello and welcome to the Biz News Briefing. I'm Patrick Kidd, reporting live from beautiful sunny Hermanus on the first day of our annual Biz News Conference. This is the 8th edition, BNC 8, day 1, the 10th of March 2026. You can expect to see a lot of great content coming from this conference on all our channels. On tonight's show, oil's wild ride as markets look for an Iran war off-ramp. A results update showing pockets of strength in banking, property and fintech. UBS on why energy prices matter most. And a wealth-building tip from 361's Cy Jacobs. Oil prices whipsawed after President Trump said the war in Iran could end very soon. Markets are watching for signs of a peace deal, possible strategic reserve releases, and safer passage through the Strait of Hormuz. Our partners at Bloomberg report.
Oil markets are whipsawing as the Iran war rattles global energy supplies, and after briefly surging towards $120 a barrel, crude has slid below $100 as President Trump said the war could end soon. For more, we're joined by Bloomberg's Stephen Szczecinski. Stephen, as I was just saying, a wild day of volatility for energy markets yesterday. I guess the real question here is, what is it going to take to stabilize prices at this point?
I think the big thing is they're looking for some sort of peace deal. I think we saw Trump's comments overnight. It looked like there was he was suggesting that maybe there would be some sort of off-ramp, that there could be some sort of end to this war. He said that they effectively already won, and there's more winning to be done. But I think the market is clearly focused on a few things. So yes, of course, the end of this would be a major thing that would help cool down prices. Two would also be the release of oil from the strategic reserve. G7 had a meeting yesterday to potentially go over that, and they agreed that they're closely monitoring the situation and ready to act if needed. And then also, lastly, if we start to see the passage through the Strait of Hormuz restart, Trump also hinted that there would be 2-degree guarantees by the U.S. Navy. He said that in the past, but we haven't actually seen any boats being used to go with any of these tankers through the strait, or if Iran has removed any of their warnings to the ships in the area. So overall, those are the three things I think the market's looking at very closely, but a lot of it is in flux, and we're dealing with huge volatility.
In today's market updates, Absa, Attacq and Weaver Fintech report solid numbers, pointing to pockets of strength across banking, property, and digital financial services.
Absa delivered a solid full-year result. Total income rose 5.2% to 115.7 billion rand. Headline earnings per share increased 12.2% to 2,987 cents, and return on equity improved to 15%. The group also declared a final dividend of 850 cents a share, taking the full-year payout to 1,635 cents. Loans and deposits both grew, while the Stage 3 loans ratio improved, pointing to a slightly healthier credit picture. Attacq reported a steady interim performance, with distributable income per share up 9.6% to 60.3 cents. Gross revenue up 8.9% to just under 1.58 billion rand. And the interim dividend lifted 9.1% to 48 cents a share. Occupancy and collections remained strong, and management upgraded full-year distributable income growth guidance between 11% and 14%, with suggests growing confidence in the property portfolio. And Weaver Fintech reported a strong set of annual numbers, with revenue up 23% to 5.5 billion rand, trading profit up 41% to 1.1 billion rand, and headline earnings per share up 40% to 552.7 cents. Customer numbers grew 40% to 4.3 million, and the full-year dividend rose 42% to 272 cents a share. The one blemish was a non-cash retail impairment. But the bigger story is that fintech now generates 93% of group profits.
UBS's Adrian Zuercher says clients remain relatively calm despite Middle East tensions, and that the key global risk channel from the conflicts is higher energy prices feeding into inflation and growth. Zuercher sat down with our partners at Bloomberg yesterday.
What's the mood like with your clients from late last week into, I guess, a few minutes ago if you were taking calls? Well, actually, so far, I would say clients are relatively calm. Of course, they want to know what's going on. They want to have news flow. They want to understand how we see the world. But we actually haven't seen too much action overall in terms of particularly no panicking, no panic selling, which I think is what we had tried to advise. Yes, there's a lot of uncertainties. There are a lot of known unknowns that might happen or not happen. And I think it's really important to have a plan, advise clients, see where they may be overexposed, where they have to reduce a bit. But there are also opportunities out of that.
Can we at least say that we've seen the worst when it comes to energy prices, at least at this point, given that we have seen a lot of options, or at least people weighing and officials weighing options to really calm oil prices moving forward?
We just don't know. I mean, the fact is we are not experts when it comes to politics in Iran, for example. We are not even probably the most best suited people to speak about U.S. politics. What we know is if the conflict basically exists for a longer period and it will impact energy prices will feed through inflation, will feed through to growth. And therefore, the longer this actually lasts, the more impact it will have and the more negative effect it will have. The shorter we actually get out of that, the quicker market can return back to normal, snap even back to the levels we maybe have seen before.
Is that the first thing to watch, though, for now? For whether things to stabilize? Is it still the oil price? Is it dollar? I mean, what is it that you're looking at?
Well, absolutely. I mean, the macroeconomic impact itself from the region is very, very small. The transmission is through higher energy prices. We know that every $10 increase will probably take off 0.2% of global GDP growth. It has an impact on U.S. consumer, probably also around 20 basis points, 30 basis points every $10. It has an effect on gasoline prices. And it's a global price setting. Even if the U.S. is maybe self-sustained in terms of energy, it's a price taker market. It's global pricing that is setting up, and therefore will have an impact on consumption.
And our wealth building tip of the day comes from 361 Sa Jacobs. He says this isn't the time for bravery. Position defensively, cut high beta risk, and remember that cash is a valuable buffer.
What is your advice then to your clients, to the guys who entrust you with their money there at 361?
Well, I think it really depends on the individual mandate, that we have from different clients. So, every client of ours may be in a number of mandates or a single mandate. So where the client is invested in an SA equity mandate, and that mandate has to be 100% or 95% at least per law long equities, obviously we'll try hard in the most cautious of equities, and equities with low multiples, high dividend yields, have some gold, have some like the British American tobaccos, things with high dividend yields, things with rand hedge capability. As you've seen, emerging market currencies have given up a bit of ground on the back of this strike. So, had you been in pure rand hedges, you've got a little bit of cushion around that. I mean, the indices so far, year to date, haven't done badly. They've done phenomenally well in SA. So people invested in long only might have taken a little bit of a hit in the last day or two, but overall, over the last couple of months in this year, it's been a very good mandate to be invested. If you're in a balanced fund or a hedge fund, which we also have a large amount of assets under management invested in, there we have been over the last few months reducing our exposure to equities, particularly those equities that have higher betas, in other words, more higher valued shares, those in technology, or businesses front-facing of the consumer. And we've moved a lot more into conservative equities, into more cash. In the hedge funds, we actually have a little bit more of shorts, so we've actually gone the other way in some equities and reduced our net exposure in the market. So if we took a portfolio of 100 Rand, our nets are more or less running like around about 40. So we don't really have a massive exposure to the market. So that's kind of saying if the markets come off 10%, maybe we'll come off 4%. And in fact, we then have options in our hedge fund to try and protect that 4%. So the whole idea in a hedge fund is try and protect yourself when you think that the markets will have a deep drawdown or big volatility. So it really depends, so in the long only, you're positioning defensively. In balanced funds and hedge funds, you're trying to take out your equity and rather sit in things that will protect you during these times. And I think it's not a time to be brave, as we're unsure how long this will last. And I think for now, cash is key.
That's been tonight's Biz News Briefing. I'm Patrick Kidd for biznews.com. Again, reporting live from BNC8 here in sunny Hermanus. Thanks for watching, and we'll catch you again tomorrow.